Hey everyone, Derek here from Dividend Talk. Every week, myself and European dividend growth investor will sit down and chat about what's happening in the world of European dividend growth investing. This week, our main focus is about planning and starting to prepare for 2026, but also how we ignore our impulses during this time of the year. Now, if you want to continue with the conversation after the show, then please feel free to join us on Facebook or Discord. There's a whole community of dividend investors there willing to share ideas and tips to help keep each other motivated. You'll find all those links in the description below. But in the meantime, we will see you on the inside. Hey, European DJ. Black Friday is here and I'm curious. Did you buy anything?
Yes, I bought something. I bought an Apple Watch from Apple. I felt like I need a new smartwatch. I don't like the fact that you need to charge it every day, but I'm going to experiment with it, experience how it works. But I got, Apple doesn't really give a lot of discount, but I got some discount on it. And, I felt like, why not? It's an early Christmas present. So there were my impulses already. But I earned some money on it. And I still have a few Apple shares, so I'm okay.
I was going to say that, these, you often see these posts. Instead of buying Apple products, buy Apple stock. You've just done the reverse. You sold all their shares, well, most of their shares.
With a lot of profits. So I think I earned myself an Apple Watch with this by just holding on to it.
They should have sent it to you for free.
Yeah. So I can pick it up tomorrow. That's how it goes. So I'm looking forward to it. For the rest, and there were a few subscriptions that we use for our premium newsletters, right? Like Data Provider and such. So they had some nice Black Friday deals. So we locked in the price for another year. So that's also helpful for us because in our case, with the prices we charge, every little breadcrumb helps us, right? To keep the cost low. Other than that, not really. No, I'm not so much of I'm a man, what do I need?
Yeah.
I need a television, I need a computer, I need a couch, and I'm a happy man. What else do you need?
I was sitting there having coffee with my wife this afternoon, and she asked me that question. You buying anything today? It's Black Friday. And I was there, I'd like a new phone. I have my phone 2 years, and I do like a good phone. I have a Samsung S23 now, I think it is. And I was like, I think I want the S25. And she goes, is that a want or a need? I was like, good.
Oh, she's a keeper.
Good point, I say. Good point. You know what? I won't buy anything.
Yeah, exactly. I'm like you. I'm the one always. In the end, you get at a certain moment new stuff, and it looks like you've new stuff, but I can easily do 4 or 5 years with a phone. Yeah, I can't be bothered. For me, the most annoying is if the battery is quickly empty. If you're effectively walking with a backup battery pack in your pocket on top of your phone, then you usually know it's time to do something, either to replace the battery if it's possible, or to get a new phone.
Yeah. Anyway, that's enough about Black Friday. We're not promoting anything here. We're not selling anything. So we'll move on from shopping. And maybe quickly tell us what's coming up in this show for our listeners.
Well, actually, we will talk, of course, a lot about preparing for 2026 and why now is actually the right time. That's our main topic of today. We'll also share some of our lessons that we have. But actually, we start a little bit with news of the week. I want to talk a little bit about oil and about something that I read in the AG Bell report. They release a quarterly report about dividends in the UK. Always interesting.
Yeah,
we'll address a few dividend announcements. So if people are interested in HP Inc. and LVMH, then stay tuned. Also, after that, we will discuss many listeners' questions again. And actually, they are quite interesting, like snowball effect. When do you really start feeling that? How can you implement the income factory theory as a European investor? Also, like, how can you find real estate companies in Europe and filter for them? So again, quite a jam-packed show. very diverse, but a very interesting topic because we often talk about some stocks or something like that, but we don't really often talk about the long-term part of the essentials of planning and such.
Yeah.
We mention it, but we never really go a little bit deeper into it. And for me, this is typically the time of the year that's very busy. And I think this applies to everyone. But the real busyness starts in December. So there are a few things that we can really later zoom into, like why is now a good time?
Yeah. Okay, so with all that in mind, let's move on to the news of the week. But before we get there, it was Thanksgiving in the US this week. We do have quite a listener base based in the US, so I hope you all had a really good Thanksgiving. I know it's quite a big thing. My sister lives over there, and to see some of the family stuff going on there is quite nice. So I hope you all enjoyed that. But what about oil this week? It continues to trend down.
Yeah, that's why I want to bring up, because people know that I'm a fan of oil, the dark black oil. And do you know that's already trading now the 5-year low? We haven't seen the oil price at this level. It's $60 for the WTI. We haven't seen it since COVID.
Yeah.
Amazing, right? Thinking about the whole AI boom that's going on that needs so much energy. You don't see it reflected in the oil price. Yeah. There was a spike after also the Ukraine war when it started, when all the gas prices and oil prices spiked, even above $100 in 2022. Now 60. It's amazing. It's really amazing. And actually, there are some stats that also show like inflation adjusted or money supply adjusted, that it's like at one of the lowest points in modern history, let's say. So that says a lot, right? About oil. Companies are still profitable, by the way. So this is really good. At the same time, it's very interesting because also the oil price went down a little bit this week. If you zoom out, it is marginal. But because of an upcoming potential peace deal between Russia and Ukraine, which I hope they will come up with, because it's good for Ukrainians, it's good for Europe that there comes peace there. But of course, I have the European view of like, it needs to be fair. Yeah, fair deal there.
Yeah, of course.
But I don't want to go too much in that. What for me is interesting then also to read, for instance, the report of JP Morgan Chase, because in the headlines it was written at, this is what I hate in the news nowadays. It's so much clickbait. They say like, JP Morgan thinks we could potentially see $30 oil in a few years. Or it even doesn't say potentially, just we'll see. Yeah. But you need to read the report. And in the report, they're actually predicting like a Brent crude, $57, and this one WTI $53 in 2027. That's not $30. Yeah. So they're actually saying mid 50, and that's because they say that there is still significant oil surplus in the next 2 years from a lot of supply growth, which is outpacing weak demand at the moment. And we see that consumer demand is weak. I don't need to see statistics for this, because when you read the quarterly reports of the consumer defense stocks, you can see this and as well. So we know this here, the demand is weak. I was a little bit surprised about the supply there, because CapEx investments have been very much brought down since 2016. Yeah. And we know that in the long term, there's a CapEx gap. Yeah. So an underinvestment for the long term. But I guess over the next 4 or 5 years, it's not considered long term here. Maybe in JP Morgan's world, but now we think about retirement, right? So 20 years or something like that forward. So I find it very interesting. What I'm really happy at least with is that companies at this moment in time, like Shell and such, are all still able to make more than enough free cash flow to cover the dividends and even surplus with buybacks. The issue is, I think that the buybacks will go down under such a scenario, and maybe even to just stopping at a certain moment if it's 53 consistently. because they will need to protect the net debt to equity ratio also for their own safety net, because we're not even talking about the bottom of a cycle here. Yeah, there's not now a global recession going on and oil is at 30 or something like that. That's when they need to let those leverages go up. So yeah, what they do say is in extreme oversupply cases, prices could drop to the 30s by 2027. Also geopolitical tensions or OPEC actions might change this, right? We know this. So effectively, they say the sun can shine and it can snow. We don't know.
Exactly. Yeah. They're just throwing something in the sand, and
but the headlines are everywhere: $30 oil, $30 oil, and it was not just JP Morgan; it was also another bank like that. I mean, guys, what is this about? They just give some proper news.
No. This is what we want. We want those headlines. Put fear in people. Drive these prices down. I mean, like Shell, Total Energies, all these type of companies. I think the dividend is covered, which was at €30 or $30 per barrel anyway. EOG I have is covered at $30. So I'm happy to see headlines like this. It creates a bit of fear. Might drop the prices.
But I have an issue with the media outlets, because even on a podcast like this, we didn't do the disclaimer yet. We need to be always really watching out that it's not considered as advice. But if you put those headlines in, people get scared. Some, they don't even look further, and they might sell oil stocks then because they think like, oh, better to get out now. Yeah.
Yeah, but then
where do you draw the boundary of what's ethical?
Are you an investor if you just read a headline and sell because you read a headline?
Yeah, but you're right. But that's not how ruling is typically, right? You have, how do they call this, fiduciary duty or something like that?
I get it because people are easily influenced. But I mean, again, if you're selling or buying based on a headline, it's different, right? If we speak about a stock, and that's why we do a disclosure, a disclaimer that we just do this for entertainment. If we speak about it and we're so passionate about it, you listen to it, you could be influenced. I can understand that a little bit.
Yeah.
But seeing a headline saying we could potentially see $30 per barrel and you sell because of that, I mean, that's not investing to me. That's
you're right. Yeah. Not to me either. But okay, probably all the AI algorithms pick up the sentiment about oil and they do this auto trading then. And
exactly.
With other people's money.
Yeah.
Good. Then what other also caught my attention was from this AG Bell report. I can very much recommend reading it. Just Google for it, AG Bell Dividend Dashboard. That's how it's called. And it does all the time, every quarter, it looks into the FTSE 100, the UK stock exchange. And what was interesting is that for the first time since COVID 2020, the dividend cover dropped under 2. Yeah, that means the earnings are now less than twice the dividend.
Yeah.
Which means the payout ratios are now more than 50%.
Yeah.
Interestingly, in 2015, the dividend cover was only like 1.3 or something like that. So it's really good up till 2022 when it was at 2.5, but it started to drop again quite significantly, which effectively says that dividend growth is outpacing earnings growth. And we see that as well with a lot of our holdings. The more conservative holdings, they are adjusting the dividend now. We'll soon go through a few dividend announcements here. But we have seen some weak dividend hikes lately. And it's really related to the earnings growth as well. Yeah. It's good to see that from one end. Like if you have like a worse year than the year before, then don't come with a double-digit hike if you don't need it. Investors understand. Interesting to see this trend because I've seen generally, and I haven't done the data analysis, but I kind of guess if you would take the Max 7 out and such, and you look at the rest of the performance, it may not look so good.
Yeah. Out of the US, you mean take the Mag 7 out?
Yeah, and I will come back later to about the forecast a little bit.
Yeah. But I'm not surprised to see this in the UK. We know that market is soft at the moment. At best, it's been struggling for quite a few years. What we notice is dividend growth investors, if you run screeners, a lot of UK companies pop up because they have lots of really good dividend paying companies in terms of their history. They're now trading at valuations or yields that are historically high. I put Diageo in there, for example. So you automatically get, lean towards the UK, but it is a soft market. It is tough, and earnings are slowing down overall. So I'm not surprised.
I was listening this week to the Prime Minister in the UK presenting the UK budget, and then also the opposition responding to it. But what I did, I downloaded the whole PDF from the government website and I put it in Google Deep Search, and I asked it to evaluate it like an economic Nobel laureate or something like that, and testing it against all the proper economic theories and everything.
Yeah.
And Google Gemini was very criticizing the budget, very much criticizing it. Effectively, what it's saying, it's doing too short, too little to support productivity. It's very weak in there. So Google, based on as a very smart economist, is very worried about the productivity side of things, and there's too much risk in the proposals. If one little thing goes wrong, the whole plan will not work. That's kind of what it comes down. So very interesting to read Google via deep search actually analyzing this and then giving the verdicts also with quite a lot of references to data. And I clicked a few on the sources to verify, right, if it's hallucinating or not. But I was quite impressed with this, quite impressed. Yeah. So, which is interesting because you could wonder now, if you are a politician and you're setting a budget, load it up in deep search, see what the weaknesses are, and prepare your counter arguments for it.
Yeah, you can't do that. How safe is that? A country like the UK putting up their accounts. They couldn't possibly. If they had their own version that was highly secure, I'm using my hands as these inverted commas, maybe they could. But you think these guys that are running countries will have economic degrees anyway? They should know this stuff. They should not need AI. I know.
Yeah, but there's a lot of there's a political layer over it.
Yeah,
and this political layer is driven by how they are elected and what people expect or not. So if you can't necessarily purely apply an economic model. So I think that's blended in, and that's maybe why it sometimes can go wrong here. Yeah. But it was just, for me, it was just interesting to test the tool like that and to really see, because with this, you can then also you can challenge politicians a little bit better on things, as such.
Yeah. And look, we spoke about Google. I think when we spoke about AI stocks last week, I think Gemini is probably up there as it's far.
I almost switched entirely from ChatGPT to Gemini lately.
They have a feature that we were highlighted to on, I was at Discord or Facebook. It might put us out of a job, but they have this podcast feature where you can upload an annual report and get it to narrate it.
There's a notebook LM. I use that sometimes.
It's in Gemini as well.
In Gemini as well now?
No,
I thought it's Notebook LM.
Maybe it's Notebook LM.
Yeah. Notebook LM. I use it quite a lot for research because I often upload, let's say, 10 annual reports, historical, and then I ask it to create tables for me that management doesn't do for me, like the historical tables. And it hardly makes any mistakes. Sometimes I spot a few because I still track, right? I still click on the footnotes because I can't make a mistake in the data when I'm doing analysis. I would say 90% of the time it's correct.
Wow.
So it really saves me a lot of time from data scraping everything. I let Notebook LM do the data scraping. And sometimes, one time I saw a technology report, 500 pages or something like that, and I uploaded in Notebook LM and got a podcast of 40 minutes out of it. And then when you drive home after work, you're informed. You don't need to read 600 pages. When do you ever have time for that, to sit behind the screen and read 600 pages?
It's awesome. And you can kind of tailor it, I suppose, to the angle you want to get from it.
Yeah, well, you can actually, during the podcast, you can ask questions and it will respond to that.
Yeah, we do live shows. You can ask us questions as well.
Ooh, you're getting jealous here. You're feeling competition.
Not at all, not at all. So let's move on to some recent dividend announcements. And you mentioned a couple of them in earlier in the show, but we'll start with, I always prefer when we had Mike, the dividend guy, on this show, maybe 2 or 3 years ago, and he spoke highly of this company, first of all.
Yeah.
But when he pronounced it so well. It's Alimentation Couche-Tard. I said that my best Irish French accent. But they had a nice 10.3 dividend increase.
Yeah, so that was the nicest one this week. Really nice one. Good one.
I don't follow the company, but it'd be interesting to see how they've done since Mike has last been on the show.
You know the brand, right? Circle K?
Circle K, yeah.
You have the gas stations as well?
Yep.
Yeah, we do.
Yeah. HPQ, one of your favorites, I would say. I don't know if favorite might be a big word, but one of the company you like hiked its dividend by 3.66%.
I was a bit disappointed about that because the payout ratio is relatively low. I understand why they do it. They're almost keeping the dividend hike in sync with the buybacks. So I think this company just prefers a lot of buybacks and reducing share count when they have cash left, and I think they want to keep the dividend baseline low. That's my suspicion here.
Yeah.
But that's why there's so much value in this stock. So this is more for me like a value investor. Though the yield and cost is becoming quite nice for me now.
Yeah.
You own them as well, right?
HPQ, no. No, I don't know.
Okay. You had a call option, put option one time.
Often I sell put options on them. I think I still have one open. When it dips really hard, because from time to time, know some of these companies that dip like 10%.
Well, they did it again, right?
After earnings, yeah. So after earnings, if they dip 10%, a company like that, I'll
they're quite low, 23, 24 at the moment. So I'm in the minus on HPQ.
Okay.
Full disclosure, I've got a quite large position, but I can't be bothered about where the price is now, to be honest. But if I wouldn't have reached my limits already, I would have, of course,
buy more.
Yeah, dollar cost averaged, but now I really need to bite my tongue on this one.
Yeah. Hey, you've got rules, stick to your rules.
Yeah.
Thanks to Thomas, who actually called out a Belgian real estate investment trust that's listed on Euronext Brussels. So the company is Essentio, and it raised its dividend for the 11th consecutive year by 3.49%. I don't know much about this company. I'm not sure if you do.
No, but I've been studying a little bit more the European real estate companies, and I haven't finished my study yet. I did a deep dive on Cibus, Nordic real estate, two weeks ago, and that's why I got really interested, like which are actually similar ones. Yes, so I'm still trying to compile some data. I need to give it more priority.
Okay. Omnicom Group hiked its dividend to 14.3%. That's quite a nice dividend hike. And LVMH kept its interim dividend flat again. This is the second.
Third year, actually.
Third year in a row, is it?
Third year, no, yeah. We know what LVMH is struggling with. Yeah, the sales headwinds, Asia, luxury a bit under pressure. So it's a sign still that they're committed to the dividend, right?
Yeah, look, they're keeping it. So let's see how that one plays out. We also got a question about LVMH. The dividend looks flat. Dividend growth CAGR is declining over the last 5 years. So do you think the stock merits a place in a dividend growth portfolio?
Yeah. Yes, because it has been growing over the years quite significantly. The CAGR is going down exactly for that. Third year in a row now the same interim dividend, 2 years in a row the same final dividend. So it's just, this is the thing with these European stocks, also like LVMH. When they are having earnings headwinds, you will not see them growing the dividend with 1 cent. They could make it €5.51. I think it would just push us over the edge with that one. It's just a European behavior, European culture. But over the long term, if the earnings continue going to grow again, you can expect very high hikes like they have been doing also after COVID. I mean, the hikes that they were given were really juicy at the time.
Yeah, that's the key. That's the key to the question, right? If earnings continue to grow. Dividends will follow.
But that applies to every company over time. Yeah, it's just like the Europeans are more following a staircase rather than an exponential curve.
Yeah, we follow a strict dividend policy based on earnings. That's essentially it. Cool. Some nice hikes there. Omnicom Group was one that kind of stood out to me, and obviously our good friend Circle K as well. Did quite well. So let's move on to the main topic, and I mean it's kind of broken into two parts, right? So preparing for 2026 and planning. But I think in order to do that, I think it's quite good to look at some of the professionals in the area and what are they thinking about the next 12 months? What are they expecting to see from Europe, from the US, or even further afield?
Yeah, so I took I took two sources, Goldman Sachs and Allianz, an American view and a European view. Let's call it like that. And particularly a little bit also more on the European stock market. And I always like it. You can see when these are analysts, when they say European equities. Yeah, that's not the language we use, right? We say European stocks here. But they forecast that they're going to climb in the coming months due to an improving economic growth. And they expect strong returns of cash to shareholders. And they do think that potential gains will be limited by a drag on earnings from a strong euro currency. So let's see how that will work. But the strengthening euro against the dollar, we have seen that already this year. Yeah, I think it went from almost $1 to 1.15.
Yes, if I remember.
So it's like a 10% or something, 10 to 15% we have impacted. So on 50% of my portfolio. So probably I could have performed 5 to 6% better this year on my portfolio, let's say. They think that over the next 12 months, the Stocks Europe 600 index will grow by 5%. If you include dividends, 8%. Which is interesting, and we can't pull it up here, but they have a picture and they show like how this Euro Stoxx 600 has been performing since, let's say, January 2024. And you see it's very volatile. And it goes up and it goes down. And then they just drag a dotted line right up. And you know what? It reminds me that I've never seen a forecast going down.
Do you know what? I have a funny story. It's not even stock related on that, right? So I was sitting in a meeting once and we have to forecast yield, OEE, efficiency, uptime of a line. And we had a new guy come into our company, a really great guy, forward thinking. And most people had to present what their targets were. And everyone did this. Everybody did this, right? This straight line up, this is projected. He didn't. He drew it down and like kind of oscillating and stuff, and he was picked out by the site manager and asked, "Why would you predict that?" And he just said, "Because it's not going to go up in a straight line. That would be wrong. We're going to see peaks and troughs, and this is more representative." And I think he was only in the job a couple of weeks, but he won the whole place over with his honesty. It was quite refreshing, and that's what you want to see, right? You want to see that honesty, not going up in a straight line. Like
no,
this,
it's probably his bonus line anyway. Allianz is actually quite specific. So imagine Goldman Sachs, 5% growth, 8% including dividends. What the Allianz says is they expect a profit growth for the same index to accelerate to 12% as currency headwinds fade out. So the other one is saying stronger euro. This one is saying like it's going to fade out. So Allianz is a little bit more bullish. Also, the negative impact from tariffs will diminish and companies will adjust and the macroeconomic environment improves. So this person took a happy pill while writing this. Yeah. So still, they do think that it will also reduce, therefore, the growth gap to the U.S. Stock market, S&P 500s, but still they expect that to grow by 14%. Again, double-digit numbers there. Very, very interested. Very interesting. They do think that. I said there's, of course, an outsized impact of the contribution of the Magnificent Seven there. Interestingly, they add a chart there also. If you look at MSCI Europe and S&P 500, and if you anchor on 100% in 2014 and put them equal weights in terms of earnings, then the Europe is now at 167 and the S&P 500 on 250. So there's much more earnings growth in America relative from an index point of view. We know this, but it's kind of shocking to see that the gap is becoming so wide over time. Yeah, it's really like it may be on a year basis 2%, but then after 12 years, this is a very wide gap, and we're talking suddenly almost about 25 to 30% gap, in earnings growth. So, but then also relative valuation, they feel that the European MSCI is having a valuation gap of 33% to the S&P 500. So also arguing that there's opportunity for European stocks to start slowly closing that gap based on the reasons of the currency headwinds going away, the tariffs impact smoothing out, which was already the narrative, I would say, a lot this year. Yeah. European stocks have generally done well, I would say. But this is a bit of prediction. Not a lot about dividends in here, but we know that dividends follow earnings. So if Allianz is right, and we will see a 12% average profit growth, earnings growth, then we should see also double-digit dividend growth.
With this type of report, these types of reports focus you in a little bit more on European equities, our stocks, European stocks. So,
to be honest, I do this purely for entertainment. I would love to see it as toilet paper in my house.
I was expecting a no answer, but I was not expecting that answer. But yeah.
No, I take this with a grain of salt. I think they look at the data really well, because this is the data, yeah. But then how they predict going forward, I don't know. I mean, they could write anything down to in terms of prediction. Yeah. What I do know is that most of the predictions never come out. I mean, again, in the beginning of the year, people were predicting, and then Trump comes in office and starts a tariff war. I mean, how can you predict against that?
Yeah, and we can already see between Allianz and and Goldman Sachs, there's two different
views. Quite a gap.
Yeah, I mean,
two different views. But that's why I'm sharing it, because it's interesting. Here, both are also very positive. And then what we are reading at the same time, AI bubble, most expensive stock market ever, Sheila PE through the roof, it doesn't even fit on the chart anymore. Yeah, and then you see this, 12-14% up next year. Good luck, guys.
You can just picture someone sitting in a little room with headphones on, going la 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 la.
Exactly, watching the Smurfs on the background,
just typing away, saying everything is going up. But hey, let's see. They're both very positive, but I don't think they're going to come out and both be very overly negative at the moment either. So
no. But when I read earnings reports, so let's say I don't look at macro data like they do. Yeah, and that's why I find it fascinating, the statistics that they are bringing up, and those are real statistics. Yeah, but what I continuously read in the reports is weak consumers, the impact of tariffs, all the time, and specifically weak consumers. We see Walmart doing really well. Other consumer companies like that not so well as Walmart, but Walmart is a low discount. Here, which actually plays into the narrative of the weak consumer as well, and we see it everywhere. We see that price inflation is not working anymore. Look at Clorox and the likes. Yeah, they are done hiking their prices. It needs to get back to volume growth. They're struggling with that. And the fact that they can't do only price hikes anymore means that they are too far already with their prices, and if they increase more, volume will not be compensating for it anymore. Yeah, and then you have all the how do you call this other brands like, let's say, the Tesco has its own brand. How do you call this again?
Oh, not just Tesco won't. I know what you're saying.
Yeah.
They are their own brand.
Yeah, but those are now, in the past, there was maybe a 30 or 25% gap. Now, sometimes it's like just half the price. Yeah, if I walk around here. So, and we read all those reports, and for the show, we do a lot. So, I can clearly see it from that point of view. And I know we are in the corner of dividend growth stocks, but those stocks are effectively operating the world. Yeah, with our diversification. So, yeah, I'm very curious where this 12 to 14% will come from with a weak consumer. I'm really, really curious.
Yeah, yeah. But let's see. Let's see. We won't go into macroeconomics now. But a weak consumer is it's Europe, but more so America. I think America is probably very weak. UK, I would argue, is weak as well. But let's see.
Yeah.
Let's see. Anyway, second part to this is kind of lessons from our past, and that normally helps you when you're preparing for the future, right? It's good to look back the way. What did you do wrong, so you don't make those same mistakes again? And I mean, what are the key lessons you have going into 2026?
Well, there are a few of that. And I think every time when I also do my annual report review, a few things come back. And one of the things is like dollar cost averaging. It's not easy when you're stock picking. I see it the last 2 months I've been investing a little bit less because I couldn't always find the inspiration of what to buy into. And I have already like 50 something stocks in my portfolio, and I want to keep it a little bit contained because otherwise I will end up with 100 stocks and it's too much for me. So investing regularly is not always easy. I do pay myself first, so the money goes to the stockbroker account, but then finding the stock that you want to buy, and it is much more easier if you have a young portfolio. Yeah, because okay, I've got 5 stocks, let's buy another 15. It's not an issue. But in my case, I'm at the 80% financial independence level. Yeah, and many positions are filled up, and I have my rules. I don't want to buy more, so I'm looking at those few positions all the time, adding a little bit, or being very, I said, frugal on the stocks that I want to add still to my portfolio. So I added Euronext not too long ago, right?
Yeah.
So investing regularly is not always easy. Also, you get distracted. Work is busy, but it's very important, yeah, and that's where having a plan really helps. Like what I say, pay myself first, have a plan of what you need. So what I do at this time of the year, I kind of forecast what my salary will be, if I will get a salary increase or not. And I start to think about, okay, how much money do I need to send to my brokerage account each day? But my money is also fluctuating because we get a bonus or something like that. So you get also suddenly a lump sum there. Will you use this entire lump sum at that time when you get the bonus, or will you split it out? I typically split it out, yeah? So all this planning is also a little bit needed, because otherwise you may be under-investing at a certain moment, or over-investing too much, and therefore put too much in a single month. But that depends on what you want to do.
Yeah.
So those are two, for instance, important things. And sitting down now a little bit before the Christmas, because also with the Christmas was good to know, I can do some tax harvesting because we have capital gains tax here. I sold a lot of Apple stock, so I'm the plus. So I'm now also looking at some of the stocks where I'm in the minus, where I think like, okay, let's use it for tax harvesting, specifically those where I have not a lot of conviction from anymore because the thesis changed or something like that, so that I avoid, let's effectively, a large tax bill.
Yeah. Actually, that's a good reminder because December is coming up, so we have to file capital gains tax in December for the first 11 months, and then again in January if we make any sales in December. So I need to get on that. But yeah, I think you're right on what you're saying. I suppose you're working in a smaller universe of companies than say I am, because my portfolio is a little bit younger, knowing that some of your positions are full.
Yeah.
And will that play then into your future planning for next year? Will your universe just be smaller? Will you focus on a set number, or are you still open?
So I'm open to increase, but I'm now at this point in time that I say, like, if I add a new position, I need to also know which I'm going to throw out.
Yeah.
Yeah. So what I have is a position of 50 stocks, let's say, portfolio, and I added 10 stocks more for income factory stocks. So stocks that maybe don't have the highest dividend safety profile, but are more for the income generation based on the income factory. So I've got 2 or 3 there now. So yeah, 50 it is. So so that's why, for instance, throughout Viatris, the thesis changed. It's not so much that the dividend safety was entirely at risk for me. It had already flat dividend for some time, but I thought like thesis changed and there's a better stock with a higher quality that could be in there. And it's also, by the way, a really good mental model to every time when you buy something, is this one better than the other one that you have already? Because otherwise you should probably be buying more of what you have already.
Yeah.
So I've got those few stocks that are not full yet in position size, and I want to test to them mostly.
Yeah. Nice. Yeah, I think for me it's all about conviction. It's the one thing I've learned from my past is doing your research and sticking to that. I've spoke many times about selling too early, and I mean that's happened on so many occasions, but maybe 2 or 3 that I can think of that have been probably wrong. Microsoft, for example, is one sold out too early, and they doubled, trebled in share price, and ADP was another one.
Yeah.
So for me, it's about, and I think the podcast helps, but I think also our newsletter where we actually do deep research, because I know when I'm researching stocks myself, it can take a bit longer, and sometimes you might get lazy and you might just do maybe half the work, 3/4 the work, and then life gets in the way, and then you're kind of happy and you just buy it without as much conviction as you may think you have.
Yeah.
Obviously, when we write a newsletter, we have to finish the job, right? So it forces you to do it, and I think that's after helping me with discipline, I would say, but also with conviction and sticking with what I know.
What is really helpful with that, I've seen this pattern that beaten down stocks in this year, they will be used a lot for tax harvesting. Also, fund managers will not want their stocks in their final report. Yeah, so you see a lot of this selling going on, and typically from January onwards, you see that many of those stocks bounce back again. So if there are beaten down stocks, and for instance Target, or Novo Nordisk, or PayPal, name a few like those, right? Vici, they are likely to still go quite a bit more down in December, if any past history of what I've seen with these kinds of stocks is any guarantee for the future. Because stock funds will not want them in their end of year review list, so they may sell them, and also for tax harvesting point of view. So you will see downside pressure on those ones, but then they may be the top performers from next year's again by bouncing back. So if there are a few of those that you see, and you study them now, because maybe in the next few weeks you will get a Christmas discount on those, purely for the reason of this tax harvesting that's happening in the market.
Yeah, I hope Vici's one of them, because I probably will be a buyer if they.
Yeah, but what I would suggest is like this is where you can't borrow conviction come in and do your own research, right? Because otherwise you will be just buying something and
because it drops.
Maybe Yeah.
No, I agree. And I think it's really important. It's our whole philosophy, our whole point of this podcast is to try and help people. And it doesn't matter to us whether they're dividend growth investors or what type of investors. Once people start investing and taking control of their financial future, but to do that, you have to be educated, right? I met a guy on the weekend, a friend of mine who's starting investing, and he's brand new to investing, and my message to him was, like, I think he was expecting me to say, right, you need to buy this dividend company and this dividend company, but that wasn't the case. It was, okay, you have a lot to learn. You have to first learn how to read financial statements and stuff before you start stock picking. So just start with ETFs. Just get started and then get yourself on a roll of investing regularly. And once you have that habit and you're reading and building up knowledge on the side, then you can start pivoting into single stocks. But I think the key message is to just start in that situation. But yeah, what about dividend safety? I think over the years, it was the 5-6 years we're doing the podcast now, we've seen how important this metric, which I say it's a metric, but it's a combination of about 5 or 6 different pillars, we call it. But I mean, it's something I swear by now. It's so important. And you can see, I know Simply Safe Dividends has a model like that, but sometimes I feel they overestimate sometimes with numbers. But I think getting a grasp of a company's dividend safety will force you to do the homework, will force you to do the research.
But now is also a time that you have the Q1, Q2, and Q3 numbers in.
Yeah.
So you kind of see already where the earnings direction is going. And now is also a good time to one more time review these companies in your portfolio. Are they still as safe as they were a year ago?
Yeah. Yeah.
So if you have some time for that now, I would do it now, because it's, it's a good time for this still before the year end.
Yeah, I mean, I think in episode 149, you gave a good quote at that time, and it was, numbers don't lie, humans do. Which
Exactly.
Which is something.
Yeah, because then we are talking about biases, right? We're talking about confirmation bias, anchor bias, all these kinds of things, which makes us effectively turn the numbers into something what we want sometimes, or read the numbers from. But if you purely look at the numbers and are strict to it, they don't lie.
Yeah,
unless there's fraud.
And we've seen instances of that.
We've seen that as well. Yeah.
Yeah.
So generally, what I would say, right? These are some lessons from the past, but what it comes down to, I think, now at this moment in time, you just need to really start thinking about what are your thoughts about 2026? How do you view the world at this moment in time? There's a lot going on in the world, right? China, geopolitical from a Western point of view, the tariffs, weaker consumer. How do you look at 2026? Yeah, I think that's a bit of a question to ask yourself. Please don't forget diversification, but start to plan already a little bit about this. Get your mind around it and start planning a little bit already, because there are not so many opportunities that you have this time to think. And for instance, if you start thinking about this now already, then you get your mind to it. And then when it's Christmas, January, when you're sitting with your family at the Christmas table and they're talking the same boring stuff like they do every year, you can really nicely wander with your mind and have those deep thoughts. And the next day when you're on your own, because everyone's sitting inside, you can really write out your plan. But it usually, at least on my side, requires a few days of letting those thoughts sink in, testing a little bit. That's now, I think, really the moment. Also think a little bit about how sectors have performed. What sectors do you think will do well? Do you think that next year will be finally the year that the interest rates will go down? Will this be bullish for the real estate investment trusts? Yeah, we had the big guy on here, was it 1.5 years ago?
Brad Thomas.
Brad Thomas, he expected it to happen in January this year. It didn't, maybe in a delayed effect of 12 months. So I think that's important to do now. And then what I would just say still with the Christmas, if we bring it a little bit back to the holiday hype and everything, just watch out for yield chasing. Yeah. Unless you are doing this with a really, really, an intention behind it, maybe high income factory stocks. So you can look at metrics and everything here, like dividend payout ratio and such, to think a bit about the dividend safety. You can look at the dividend growth potential, what it did over the last 5 years. But in the end, discipline is really key. So so if I would think about it, I think, and I want to give something helpful to our listeners, I would think about a 4-point strategy for yourself now, for 4 action points that you can do today. And the first one I haven't spoken about yet here, Derek.
Okay.
The first one I would think, because you have a fiscal year end, a calendar year end, now is the time to start looking at your portfolio costs, because that's a topic we don't speak enough about. What have you been trading this year? Yeah, what have been your buys and sells? Look at how much you paid in commissions, sum it all up, You can often generate reports at the broker and check if it's maybe the right cost level. If you find out that you're on the expensive side, check what other brokers offer. Look, of course, at the currency spreads there, because that's where some brokers say zero commission, but then the currency spread is where you pay everything.
Yeah.
Maybe even put your whole trades in Gemini, your trade overview in a CSV, upload it, put the price tables of 3 or 4 brokers in there and let it calculate what it would have costed elsewhere. Because usually around December is a nice moment to start a new broker if needed, because you get those fiscal year-end reports. Yeah. To do this mid-year sometimes is really annoying if you need to take from different brokers. That's my experience here. So I will look at that, but I also would look at what I call that's called the international return drag, to throw in a new term. But we're really talking here about dividend withholding taxes.
Yeah.
Check if those Swiss companies that you have and such, whether you're really able to claim back the tax. Yeah. But maybe try it. Maybe plan for trying it, because otherwise look at what the yield after tax is. And is this sufficient for you? Yeah. For instance, I prefer to invest in Dutch stocks, English stocks, because Dutch is 15%. That's all according to the treaties. British stocks is 0%. So I really like these markets. For Germany and France, I really look at yield after tax. Yeah, then I expect, let's say, not a 3% yield, but a little bit more, or very high growth behind it. Yeah. Sweden is the same, 30%, but there I really want to start asking back, because I hear good stories about the Swedish tax office that you typically get your money back. So that's one. Yeah. Another action that I really would say is like, do a risk assessment on your portfolio. We mentioned just about dividend safety. Are all your companies still having a safe dividend? Yeah. Look at the payout ratio. Look at the growth rates. Now is the time to do a proper audit on it. Stress test the payout ratios. Check what would happen if earnings wouldn't grow so much. Will you get in trouble? Yeah. And then the fourth one. So the second one is this portfolio risk. Also, when I say portfolio risk, I also say over concentration in certain sectors. For instance, are you exposed to maybe too much to tariffs or the chip industry? Yeah. Check that and look at it from a diversification point of view, and what could go wrong. And then if it would go wrong, does it hit your portfolio extremely hard or not?
Yep.
Because also I mentioned before to it, think about some mega trends that you are seeing. We spoke about AI last week, and we are talking about the picks and shovels of the industry more. Yeah. So what are some secular growth trends that you see that maybe some of those boring businesses and dividend growth stocks could really benefit from? Yeah. And I think that's important for every holding. You would prefer to have a secular growth trend below it. That's why these consumer staples are so hard, because the secular growth trend was always global growth, to global expansion into India, into China.
Yeah.
But that's becoming much more saturated and much more harder with the geopolitical tensions. So what's the next secular growth trend for them? If nothing, probably consumer staples are going to, I don't know, grow 1-2% in revenue, about inflation, let's say. But should you then adjust your dividend growth expectation? And if so, what would be then the right yield to pay? And that's also how you can think about this. So those would be my 4 points to maybe consider now. Have a look at your costs. Yeah. Do a bit of a risk audit on your portfolio. Look at the dividend safety and see what secular growth trends you see, and maybe use that as inspiration on maybe some sectors you want to focus on next year.
Yeah, I think there's some really solid points there, and none of this has to be too deep either. You can keep it kind of high level. Well, tax is different. You might need some help with that, right? But
if you know that 30% of your portfolio is invested in countries with, let's say, higher than 25% dividend tax, ask yourself: Is this the right? Are you happy with that level or not?
Yeah. I wouldn't, which is why I try avoid most of them. Switzerland, for example, I won't touch. But I think in terms of stress testing your portfolio for dividend safety and doing a risk audit, sometimes it only has to be a one sentence disclaimer. Like write one sentence down of why you're invested in, what your kind of thesis
and
is.
check if it still applies.
And check it then a year later. Is it still the same?
Yeah.
Is it still the same? And it can be as easy as that and stress free. So yeah, some nice tips there going into 2026. Of course, we'll probably do an episode, maybe it's the end of the year or the start of next year, about our goals for the year and maybe some stocks that we're going to look. Yeah. So we'll go a little bit deeper.
But the goals come
from this.
From this again, right? Because when you have all your learnings and your insights, you start to develop goals. I will also do an annual report that builds a little bit on that. But exactly. So you're doing kind of the pre-work now with all of this. Yeah,
exactly. Pre-work before Christmas. Enjoy your Christmas and then you can execute it. Nice. Yeah. So look, nice little topic there about how to start planning, what we will be doing to start planning, and what you can expect from us in upcoming shows about 2026. But let's move on to some listeners' questions. And we got quite a few questions again, but we got one from Var Valvi. The question is, when and how did you experience the feeling of the snowball effect for the first time? Not just mathematically, but actually feel it or see it in like your charts, your numbers, etc.
Yeah. So the snowball effect, it was maybe not even the snowball effect. What I really felt for the first time was when I got dividends, let's say 50 euros in dividends per month. And I felt like, oh, I can pay the television and phone bill with this now for the rest of my life.
Yeah.
Yeah. And then the compounding, I would say the snowball effect, I really felt it with the 100K. Because then you're suddenly looking at 3,000K net dividend coming in, which is like 250 euro a month. And then you see suddenly, oh, wait, I'm reinvesting this 3,000 at a 3% yield. Yeah. So that's 90 euros again on top of that. Yeah. And that's really where I felt it starting. And those 3,000 euros reinvested, they go all back in your portfolio. So 100,000 becomes already 103,000 plus 90 euro. And then that's still all your all your other money that you deploy to it on an annual basis, plus the growth of the portfolio, the dividend growth. And if you have also let's say 6% dividend growth, you have another 180 euros. So that's already 270 euro on the 3,000. And you're talking about almost 10% new dividends. Yeah. That's where you really feel the income growth, the compounding.
Yeah, I agree. I think once you pass the 100K mark, that's when I first noticed that when I reinvest my dividends, or even if automatic dividend drip is on, I'm buying full shares. 2, 3, 4, 5 full shares, and it makes a big difference. Before it was like fractional shares, and you kind of going, that's cool, but when you see yourself buying full shares of the company from your dividends, I think that's when you go, okay, I can see where this is going. So yeah, that's when I started to feel it, not mathematically, but actually feel that compounding was starting to take over. Yeah. Okay, and then the last question goes to Overachiever 77. So what is your take on sin stocks like Vici, which supports gambling, obviously, or Rheinmetall in the defense industry? I have no problem with sin stocks. I think you can see that in my portfolio. I have tobacco stocks. I have some defense stocks. I also have gambling stocks. So I own Vici. I did a deep dive on them way back, revisited them this year, I have to say. Their growth is slowing, but I think Vegas is still very much alive. I mean, the key there is their two big tenants, which is the big risk. Growth will slow down. It's going to be more like a bond proxy. So you just have to be careful. You get a decent yield, about a 6% yield for that. But in terms of my take on them as a sin stock, my take on all of this is those companies are going to be around if I invest in them or not. I'm only a small retail investor. I'm not going to move the needle on these one way or another. Do I think they're going to make money? Yes. Do I think I'm going to make money? Yes. So if those two things match up, I have no problem in investing in gambling stocks or defense stocks.
Nice.
Yeah. So that is the end of the show. Again, as always, thanks for all the questions. Hope you enjoyed the topic, and we shall see you all next week.